All right, let's dive into Borr Drilling, ticker BORR. We're breaking down their third quarter 2025 earnings call. Now, the stock has had a pretty significant run-up lately, so investors are really watching to see if management can keep this momentum going. Let's get right into it.
So, here's the big question on everyone's mind. Was this quarter the real deal? The turning point for the company? After a pretty tough year, Borr is definitely showing some positive signs. But is this recovery built to last? That's what we're going to figure out by digging into the numbers, their strategy, and of course, how the market reacted.
Okay, here's how we're going to break it all down for you. We'll start with the Q3 snapshot, then we'll pull apart what drove that performance. We'll look at a really critical strategic move in Mexico, see what the markets thought, and then wrap it all up with our own rating looking forward.
First up, the Q3 snapshot. And really, the headline here is, well, it's pretty simple. Borr absolutely delivered. This was a clear and convincing beat across the board.
Let's start with the bottom line. The company posted GAAP earnings per share of 10 cents. Now, you might be thinking, 10 cents, what's the big deal? Well, Wall Street was only looking for about 7, maybe 8 cents. So yeah, that's a solid beat of around 25 to 30%. Not bad at all.
And that strength carried right on through to the top line. Revenue hit $277.1 million. That's a 6% beat on expectations. But what's really impressive to me is the growth. That's almost a 15% jump compared to this time last year. That's some serious momentum building. Okay, but it's not just about the headline beats. What I find really interesting here is the quality of these earnings. Sure, net income was nearly $28 million, but the number to watch is that adjusted EBITDA, over $135 million. That gives them an EBITDA margin of nearly 49%. That is a very healthy number in this industry. And check out that liquidity, over $460 million in the bank. That gives management a ton of room to maneuver.
So, the numbers look great, but the real question is why? What's actually driving this performance? And when you start to pull back the layers, one theme just jumps right out. This was all about operational excellence.
You know, you don't even have to take my word for it. The CEO, Bruno Morand, basically said it himself. He called it an extension of their rebound and gave all the credit to the team for executing at the highest levels. And that's key, right? This isn't just some lucky quarter. It's the result of a game plan that's really starting to pay off.
And here's a perfect example of that execution. Let's talk about economic utilization. Now, that sounds a little jargony, but it's super important. It's not just about whether a rig is busy, it's about how much time it's actually out there making money. And Borr hit an incredible 97.4%. That is, without a doubt, industry-leading stuff. In this business, high utilization is the engine that prints money, plain and simple.
So how did they get to that crazy high number? Well, a few things. First, they had basically their whole fleet working. 23 out of 24 rigs were active. And these aren't just any old rigs. We're talking about a premium, young fleet of jackups. That makes them the go-to choice for the big players, the Shells and Enis of the world. It really just comes down to this. If you've got the best equipment, you get the best jobs.
But you know, this quarter wasn't just about working hard. It was about working smart. Management is running a very deliberate de-risking playbook, and the absolute centerpiece of that strategy is what they're doing down in Mexico.
For a long, long time, Mexico has been the big cloud hanging over Borr's head. It was their biggest headache. They had a ton of their rigs concentrated there, and they were constantly getting hit with payment delays from the state-owned oil company Pemex. It was a huge drag on their cash flow and, frankly, a massive red flag for investors.
So, what did management do? They didn't just sit around. They tackled this thing head-on with a super clear 3-step plan. First, restructure the contracts to get better terms. Second, literally pull rigs out of the country to reduce their exposure. And third, and this is the big one, they locked in much better, more reliable payment terms. This is exactly what you want to see, a direct, disciplined attack on your biggest problem.
And just look at the difference this has made. It's a classic before and after picture. Before, 7 rigs in Mexico, most of them tangled up in that Pemex payment mess. After, they're down to just 5 rigs. And get this, only one of them still has that direct Pemex risk. The rest are working for big international companies or have new protections in place. That's not just a small change, that is a massive de-risking of the story. And it shows how nimble they can be too. So international sanctions forced them to cancel a couple of contracts in Mexico. A setback, right? Not really. They didn't miss a beat. They immediately found new homes for those rigs. The Odin is heading to the U.S. Gulf of Mexico in January, and the Grid is off to West Africa. They literally turned a problem into an opportunity to diversify. That's smart business.
Okay, so we've got a great quarter and a really smart strategic shift. The next logical question is, what did the market think? How did Wall Street react? And the overall vibe seems to be one of, well, cautious optimism.
Right out of the gate, on earnings day, the stock jumped almost 6%. That's a pretty clear thumbs up from investors. It tells you they heard the numbers, they understood the Mexico de-risking story, and they like the confidence they heard from management on the call.
But let's zoom out for a second, because context is everything. This chart really tells the story of an inflection point. I mean, look at the last 3 months. The stock is up a whopping 37%. That's just blowing the market away. But it's still down 20% for the full year. This is the textbook definition of a turnaround story, where the recent good news is finally starting to overshadow the old baggage.
And it looks like the professional analysts are seeing the same thing. You saw some positive moves for sure. Citi bumped up its price target, and SEB Equities actually upgraded the stock to a buy. But the overall consensus is still sitting at hold. So, the sell side is basically saying, hey, we like what we're seeing, but we need you to prove you can keep it up before we go all in.
Which brings us to the big finish, our take on what's next and our official rating. So, what should you be watching for between now and the next earnings report? Here are the big catalysts, the things you need to have on your checklist. Number 1, can they hit that full year 2025 EBITDA guidance of $455 to $470 million? That's the big promise. Number 2, how well do they execute on those brand new contracts in the US Gulf and Angola? Number 3, watch the macro picture. Are we seeing more rig callbacks from a big player like Saudi Aramco? That would be a huge tailwind. And finally, we've got to keep seeing things get better with those payments in Mexico.
So where do we land on this? Look, management has already warned us that Q4 might be a little bumpy because they're moving rigs around. That's expected, it's just transition noise. The real story, the bigger picture here, is that this smart move to de-risk from Mexico, happening at the exact same time the global market for these high-end rigs is getting tighter, well, that's setting them up for a really, really strong second half of 2026.
So when you put it all together, the fantastic execution, getting that Mexico risk under control, and a market that's moving in their favor, we believe Borr Drilling is absolutely positioned to beat its competitors and the broader market. Our rating is outperform.
And of course, I have to say it one last time, remember, this is just our analysis for informational purposes. It is not financial advice. Please always do your own homework before making any investment decisions.